Hi, welcome to INR Bonds weekly podcast. I'm Arjun Pathak speaking. Our weekly podcast is Let's Talk Bonds, where we take you through what are the bond deals, and what are the options available for investors and for financial advisors to put in the clients' portfolios. Now, in this week's podcast, we focus on the fact that the bond yields are rising. Clearly, we saw last week that the 10-year government bond yield rose to 6.75%. These are levels seen over 2 years ago after RBI started to cut rates. And this is largely the bond yields are rising in anticipation of higher interest rates this year, especially with the inflation in global inflation is standing very high, and in India too, the inflation looking to rise. And RBI seems to be okay to start hiking rates once the budget for the 2022-23 is announced. Well, the anticipation is that there will be higher borrowing as the government spends to on subsidies because of the high raw material cost and the fact that they need to provide for the more populist budget measures this year. So with all this, investors are still seeing a very difficult portfolio time for them. The short end, if you take the short, if you take the if you want safety, if investors want safety, they are not getting they have to live with very low returns, which is well below inflation. The 1 year, 3 year, and 5 year government bonds are all in a range of around 4.5 to 6%, 6-10%. And if you go up the and even if you take it corporate bonds, the very short end, the 3 to 5 year AAA high safety corporate bonds or higher safety corporate bonds are all in the range of around uh, 5.5 to 6.5, and some of them going up to 6.75 to 7%. So these are all 3 year bonds, and again, in 3 years, we don't know really what's the scene. And even at 7%, the the returns are not so commensurate with the inflation levels in the economy, which is hovering over 6% levels. So if you take the Bharat bond ETF, the 4 year Bharat bond ETF is still below 6%, and it's not really followed the government bond. But if investors do want higher yields, but they have to go take an interest rate risk and go to the 10, 15-year bonds. The 10-year GSEC, as I said, is rising to 6.75%, and investors are seeing capital losses if they are invested in longer duration bonds or longer maturity bonds. And similarly, corporate bonds too, like HDFC, are all even 10-year bonds are trading just over 7% levels, many of them, and not really providing great satisfaction in returns. And also, they're not really protecting the portfolios because interest rates still risk is still very much alive in the system. And corporate bonds too, highly good corporate bonds, high safety corporate bonds, which is high rated, including Tata Clean Tech and others. All the 6 to 7 year bonds are all in the range of around 7.5%, slightly better returns. But again, the interest rate risk is still high because you're still going up the maturity ladder in trying to get some kind of returns on your investments. So in this case, then if you go down the rating scale, and if you are then you have um, bonds that are rated AA and to A, AA and A to A minus. These largely are NBFCs and microfinance companies, where if you can find some good bonds for these, they're all in a range of around 8.5, 10%. Some of them going up to 11%. We have some private placements from Swatantra, 5 year bond at closer to 11%. So all this is providing some investors, but again, investors some kind of returns, which is much better than what is offered in the higher safety. bonds. And clearly, I think there is a very sharp shift towards investors' preference to where the financial advisors can provide them good portfolio returns where they can assess the credit risk and invest in such bonds. And we have seen a lot of bonds that are being available on our Quick Invest platform, Quick Invest by INR Bonds app. All you need to do is download the app on iOS or Android and check the bonds that have been curated by us. And we have seen a few bonds that are even available at 6 months bonds, 8 months bonds, available at the levels of say 7 to 8%, or in 7 to 8.5, even 9% good credits. And clearly, I think these are the kinds of opportunities investors are looking at, and its financial advisors are doing will have to do their own due diligence to provide the investors the best bonds available for their portfolios in a very difficult interest rate scenario. With this, you have a lot of private placements too happening. Uh, we have last week we saw Mannapuram Finance, which floated a bond at closer to 7%. You had Mindspace Business Park rate that came out at 6.35%. Still very institutional, not very greatest deals. PNB MetLife, the insurance company, issued a longer maturity bond at 8.12%. JM Financial Credit Solutions, again, long maturity bond at 8.99%. So these companies are now trying to attract investors by offering higher maturity, but higher yields. So over 8% and close to 9%. Investors still frustrated over very low returns may just bite at these kind of levels. But again, the interest rate, the maturity is a deterrent for many investors. Mahindra Financial Services, again, very low private placement, very low yields at 6.25%. Aditya Birla Housing, again, very low yields at 6.7%. Swatantra Microfinance, which is the Birla family promoted microfinance company, at levels of around closer to 11%. Then this is 5-year paper. Edelweiss Financial Investments offered floating MLDs. These are all over 8% levels. And Navi FinServ, again, they've been very active in the private placement market, either through MLDs or through bonds. And the Navi FinServ bonds are all glowing in 875, 9.5, 975 kind of a range. So others include smaller companies and other wealth managers like Anand Rathi, who's been very active in issuing MLDs, Moneywise Financial Services, etc. They have been issuing bonds. So a lot of private placements happening as bond yields are rising, and many issuers are finding that offering attractive yields to lure investors into their to lock into rates at lower levels before interest rates rise substantially and stay there for a longer period of time. So given this, clearly, I think Quick Invest by INR Bonds is a very good option for financial investors. All they need to do is download the app and check the bonds and then select the bonds that they need to invest for their clients, because financial advisors can get all the information that they require, including knowledgeable investors, on the app itself. And it's just a very seamless settlement process, investment process for clients. And you have ready-made 20 real-time support. All you need to do is check the call us if you have any kind of queries on investing in any of the bonds listed on Quick Invest by INR Bonds. Download the app now. The link in the description below will give you the app download link, or you just search for Quick Invest by INR Bonds in Apple or in Google stores, and you will get the app for download. The download is free and absolutely the best way, easiest uh, platform to app to invest in bonds, which is we have made it very simple for a complicated, supposedly complicated structures of bonds. Thank you very much for listening in. And if you have not signed up for our YouTube channel, please do so.